A company can win the courtroom battle and still lose the empire. Fat Brands did not collapse because Andy Wiederhorn was convicted of a federal crime. He was not convicted in the federal cases at the center of this story. The Justice Department's criminal case was dropped after a motion to dismiss all charges was filed on July 29, 2025, and Wiederhorn's defense maintained that there were no victims, no losses, and no crimes. The SEC's civil enforcement action was later dismissed with prejudice on March 27, 2026, and yet, by the time the legal smoke cleared, Fat Brands was already inside bankruptcy court. The company behind Fatburger, Johnny Rockets, Round Table Pizza, Fazoli's, Twin Peaks, Smoky Bones, Hot Dog on a Stick, Great American Cookies, Marble Slab Creamery, and more had built one of the most aggressive restaurant roll-ups in the public markets. By January 2026, Fat Brands described a portfolio of 18 restaurant concepts and more than 2,200 locations worldwide, but behind the brand names was a machine built on leverage, whole business securitizations, pledged cash flows, layered subsidiaries, acquisition debt, and a capital structure that left very little room for error. This is the paradox of Fat Brands. Andrew Wiederhorn survived the DOJ and SEC cases described here, but Fat Brands did not survive the balance sheet built around the empire. Fat Brands stood for fresh, authentic, tasty. It was a Beverly Hills-based restaurant franchisor built around a simple idea: acquire restaurant brands, scale them through franchising, and collect recurring royalties from operators across the system. The model sounded clean: own the brands, let franchisees run most of the restaurants, collect fees and royalties, use the cash flow to buy more brands. In October 2017, Fat Brands completed a $24 million Regulation A+ public offering, selling 2,000 shares at $12 per share, with trading expected to begin on NASDAQ under the ticker FAT on October 23, 2017. The company was not pitching itself as just another restaurant operator. It was pitching itself as a platform. A platform could buy brands faster than a traditional restaurant company, combine back-office functions, and use Wall Street financing to acquire mature concepts and push them into franchised growth. That platform was centered around Andrew Wiederhorn. DOJ later described him as Fat Brands' former CEO and controlling shareholder. His history also mattered. According to DOJ, in 2004, in the District of Oregon, Wiederhorn pleaded guilty to payment of illegal gratuities and filing a false federal tax return tied to earlier business dealings involving Fog Cutter Capital and Wilshire Credit. That past did not prevent the company from accessing public markets. It did not prevent acquisitions. It did not prevent Fat Brands from becoming a recognizable name in restaurant finance. By January 2026, the portfolio included Fatburger, Johnny Rockets, Round Table Pizza, Fazoli's, Twin Peaks, Smoky Bones, Great American Cookies, Marble Slab Creamery, Hot Dog on a Stick, Buffalo's Cafe, Hurricane Grill and Wings, Native Grill and Wings, Pretzel Maker, Elevation Burger, Yala Mediterranean, Ponderosa, and Bonanza. The surface story was variety: burgers, pizza, cookies, barbecue, sports lodges, pretzels, frozen desserts. The deeper story was finance. The rise of Fat Brands accelerated during the acquisition wave of 2020 and 2021. During that period, the company pursued a buying spree of roughly more than $900 million, including Johnny Rockets, Twin Peaks, Fazoli's, Round Table Pizza, and Global Franchise Group. Those acquisitions gave Fat Brands scale. Johnny Rockets expanded the burger portfolio. Round Table Pizza pushed the company deeper into pizza. Fazoli's added Italian fast casual. Twin Peaks gave the company a high-volume sports lodge concept. Global Franchise Group brought Great American Cookies, Marble Slab Creamery, Hot Dog on a Stick, and Pretzel Maker into the orbit of the platform. The company was no longer only Fatburger, it was becoming a restaurant conglomerate. But the acquisitions were not powered by simple retained earnings. They were powered by securitized debt. In 2021, Fat Brands said it funded acquisitions primarily through notes issued under 4 separate whole business securitization facilities. A whole business securitization can look elegant when everything is growing. A company takes recurring cash flows, royalties, franchise fees, management fees, brand-related revenue, and uses them as collateral for debt. Investors buy notes supported by those cash flows. The company receives capital up front. The system keeps expanding. For a roll-up, the appeal is obvious. Cash flows from acquired brands can be used to finance more acquisitions. The more brands inside the system, the more collateral. The more collateral, the more borrowing capacity. The more borrowing capacity, the more deals. In July 2021, Fat Brands announced the pricing of a $350 million whole business securitization transaction to finance the acquisition of Global Franchise Group, describing it as its fourth securitization and its largest to that point. The company said, the facility, combined with public equity, gave it certainty of execution and the ability to move quickly when acquisition opportunities appeared. That was the upside. But whole business securitization has another side. When nearly all the assets and cash flows are pledged, flexibility disappears. Debt service becomes the first claim on the system. Liquidity becomes trapped inside financing structures. And if the company needs room to maneuver, the same financing tool that fueled expansion can become a cage. By 2026, the securitized debt structure was spread across 5 financing subsidiaries: Fat Brands GFG Royalty I, Fat Brands Royalty I, Fat Brands Fazoli's Native I, Twin Hospitality I, and FB Resid Holdings I. The story being sold to investors was restaurant growth. The structure underneath was a multi-silo financing machine, and in that machine, every brand mattered, because every brand could be collateral. In 2025, Fat Brands also spun off Twin Hospitality Group, the operator of Twin Peaks and Smoky Bones, into a standalone publicly traded company. On paper, the spin-off looked like another way to unlock value, but it also added another layer to an already complicated capital structure. By then, the empire was no longer just a collection of restaurant brands. It was a network of operating companies, financing subsidiaries, pledged equity interests, securitized notes, and creditors with competing claims. That complexity would matter when the cycle turned. The public turning point came in May 2024. On May 9, 2024, a federal grand jury returned an indictment against Andrew Wiederhorn, Fat Brands, Rebecca Hershinger, and William Amon. On May 10, 2024, DOJ announced charges alleging a scheme to conceal $47 million paid to Wiederhorn in the form of shareholder loans. The charges included wire fraud, tax evasion, false statements and omissions to auditors, and certification of faulty financial reports. The legal wording matters. These were allegations. DOJ itself stated that an indictment is merely an allegation, and that defendants are presumed innocent unless and until proven guilty beyond a reasonable doubt in a court of law. The same day, the SEC filed a civil enforcement action against Fat Brands, Wiederhorn, Ron Rowe, and Rebecca Hershinger. The SEC alleged that Wiederhorn used company funds for personal expenses through transactions involving Fogcutter Capital Group, another company he controlled. Bloomberg Law later reported that the SEC's civil complaint accused Wiederhorn of using nearly $27 million of Fat Brands cash on private jets, luxury vacations, and other personal expenses, while allegedly disguising those expenses as loans to an affiliate he controlled. Again, that was an allegation in a civil enforcement case, not a criminal conviction. Fat Brands and Wiederhorn denied wrongdoing, and the legal defense maintained that the case involved no criminal conduct, no victims, and no financial losses. For a company built on confidence, however, the damage did not require a verdict. The indictment arrived in the middle of a capital structure that already depended on access to financing, creditor trust, and market confidence. Restaurant conditions were getting harder, interest costs were high, customer demand in casual dining was under pressure, legal expenses were rising, and the company's debt stack had little tolerance for disruption. Then the legal story reversed. On July 29, 2025, Fat Brands announced that the U.S. Attorney for the Central District of California had filed a motion to dismiss all charges against Wiederhorn, Fat Brands, Rebecca Hershinger, and William Amon. Wiederhorn's legal team framed the dismissal as vindication and said the case involved no victims, no losses, and no crimes. The SEC case also ended in his favor. On March 27, 2026, the SEC filed a joint stipulation to dismiss, with prejudice, its civil enforcement action against Fat Brands, Andrew Wiederhorn, Ron Rowe, and Rebecca Hershinger. The SEC said the decision was based on the facts and circumstances of the case and evidence developed in discovery, and that it did not necessarily reflect the SEC's position on any other case. Legally, the federal cases described here were over. Financially, the damage had already moved into another arena. The months before bankruptcy showed a company losing operating and financial room at the same time. The cash position had deteriorated sharply. According to the company's filings, unrestricted cash had fallen from $37 million at the end of 2023 to just $2.1 million by the third quarter of 2025. The operating picture was also weakening. In the third quarter of 2025, total revenue declined 2.3% to $140.0 million from $143.4 million a year earlier, and system-wide same-store sales declined 3.5%. Smoky Bones became one of the clearest signs of strain. Fat Brands said third-quarter revenue was affected by the closure of 11 underperforming Smoky Bones locations and the temporary closure of 2 more for conversion into Twin Peaks lodges, recording roughly $8.3 million in closure-related costs and impairments. That detail matters because it shows the collapse was not only about litigation. The business was fighting multiple pressures at once. Restaurant traffic, store closures, legal fees, securitized debt, NASDAQ pressure, and creditor disputes. A heavily leveraged company can survive one shock, but a leveraged roll-up has a narrower runway, and when liquidity shrinks, every problem becomes connected to every other problem. The first visible market signal came before the filing. On January 8, 2026, Fat Brands received NASDAQ notices because its Class A stock had failed the $1.00 minimum bid requirement and other continued listing standards. A stock under $1 does not automatically mean bankruptcy, but for a company built on capital markets, it is a warning light. The next warning was the filing itself. On January 26, 2026, Fat Brands and affiliates, including Twin Hospitality Group, commenced voluntary Chapter 11 proceedings in the U.S. Bankruptcy Court for the Southern District of Texas in Houston, under case num. 26-90126. Fat Brands said the process would allow it to deleverage its balance sheet, maximize value for stakeholders, and support continued growth of the brands, which were expected to keep operating. But the securities story moved quickly. On January 28, 2026, NASDAQ notified Fat Brands that its securities would be delisted because of the Chapter 11 filing, related public interest concerns, and questions around residual equity value. Trading was set to be suspended at the opening of business on February 4, 2026, after which the securities were expected to trade on the Pink Limited Market operated by OTC Markets Group. That was the moment the Q became more than a ticker suffix. It became a scarlet letter for a public company that had built itself through Wall Street finance and was now being handed to bankruptcy court. Inside the case, the fight quickly became about control. The early weeks were dominated by governance disputes and creditor negotiations. A mediation process was ordered, and a mediator was appointed on January 28, 2026. On March 11, 2026, a final mediation proposal was delivered, and the parties agreed in principle. The resulting agreement reshaped the case. Fat Brands disclosed that Wiederhorn would take a temporary leave of absence from the debtors, that certain Wiederhorn family members employed by the company were terminated, and that most board members resigned, leaving special committee directors in place. Effective March 25, 2026, Fat Brands and Twin Hospitality obtained debtor-in-possession financing through facilities tied to the bankruptcy process. That financing was not just rescue money, it was control money. In Chapter 11, whoever funds the case often shapes the outcome, and DIP financing can transfer leverage from old management to creditors. By spring 2026, the path was no longer centered on preserving the empire intact. It was centered on selling pieces of it. On April 27, 2026, Fat Brands held an auction for substantially all of its assets. On May 19, 2026, the bankruptcy court authorized 4 sale transactions. Hot Dog on a Stick was sold to Amazing Brands, LLC for $8 million in cash, and Elevation Burger to Kuwait-based Tabco International Food Catering for $2.5 million in cash, while Twin Peaks and the remaining concepts went to lender-backed entities through credit bids. Hot Dog on a Stick closed on June 5, 2026, and the remaining sales closed on June 15, 2026. The empire was not destroyed in one dramatic scene. It was unwound through orders, auctions, financing motions, sale approvals, and creditor agreements, separated into pieces under Section 363 of the Bankruptcy Code. The brand name survived in new hands. The public company structure did not. The Fat Brands story is not a simple story about guilt or innocence. The federal legal record described here is clear. Wiederhorn was not convicted in the DOJ case. The criminal charges were dropped after the government moved to dismiss all charges on July 29, 2025. The SEC civil enforcement action was dismissed with prejudice on March 27, 2026. But financial survival is judged by a different system. A company can win legally and still lose economically. The first lesson is that whole business securitization is powerful, but unforgiving. When a restaurant platform is growing, securitization can transform royalty streams into acquisition capital and make a franchisor look scalable, sophisticated, and fast. But if nearly all the cash flows are pledged, the company may have less flexibility precisely when it needs flexibility most. Fatbrand's structure helped fund rapid growth. It also helped trap the company when liquidity tightened. The second lesson is that debt-financed roll-ups are highly sensitive to timing. A roll-up can work when acquisitions integrate well, credit markets stay open, interest costs remain manageable, and operating cash flow is stable. But when restaurant demand softens, same-store sales decline, legal costs rise, and debt service remains fixed, the model can turn quickly. Scale does not automatically create safety. Sometimes scale only creates a larger fixed obligation. The third lesson is governance. Fatbrands was not just a company with a founder, it was a company with a controlling shareholder, related party allegations, creditor disputes, and a bankruptcy process that eventually required changes in control, leadership leave, family member terminations, special committee oversight, and DIP financing. Those allegations were not proven in a final judgment against Wiederhorn in the federal cases discussed here. The DOJ case was dropped and the SEC case was dismissed with prejudice. But governance risk does not have to end in conviction to affect financing. Creditors' price risk. Markets price uncertainty. NASDAQ reviews continued listing standards. Bankruptcy courts look at control, liquidity, and creditor recoveries. By the time Fatbrands reached Chapter 11, the central issue was no longer whether the restaurant brands had name recognition. They did. The issue was whether the company's financial architecture could support them. It could not. That is the final irony. Fatbrands assembled recognizable restaurants across America and built a portfolio that looked broad, familiar, and resilient. But the structure underneath the portfolio was narrow, complex, and heavily pledged. The burgers could still sell. The pizza could still sell. The cookies could still sell. The sports lodges could still serve customers, but the balance sheet could no longer carry the empire. Andrew Wiederhorn's legal saga ended far better for him than it appeared it might in May 2024. The DOJ criminal charges were dropped. The SEC civil action was dismissed with prejudice. He was not convicted in the federal cases described here, but by the time those legal outcomes arrived, Fatbrands had already entered the machinery of bankruptcy. The story was no longer about whether the government could prove its case. It was about whether a debt-financed restaurant roll-up could survive its own structure. And in the end, the answer came not from a jury. It came from the balance sheet. This video is for educational and informational purposes only. All information is sourced from publicly available documents, regulatory filings, and credentialed news organizations. Source links are available in the description.